Hi, this is Mateus Akawan at Akawan Equity Management. Here we are again for yet another CEP study session. Today we're going to talk about ISOs, also known as incentive stock options. As always, before we start, we're going to go for a few quick disclaimers. The contents of this presentation are owned by Akawan Equity Management and are not intended to provide legal text or financial guidance. It is essential to bear in mind that this information must not be used as a substitute for advice from certified experts. This project was created by Akawan Equity Management as a nonprofit endeavor aiming to increase employee ownership awareness and support stock plan administrators, participants, and CEP applicants. Now, let's talk about these ISOs and what they are. First of all, if you haven't watched our session on non-qualified stock options or non-statutory stock options, please go and watch that session, as on that session we laid the basics and the fundamentals for stock options. Now, what are ISOs? ISOs are a type of employee stock option defined and ruled by Section 422 of the Internal Revenue Code. And if you are a stock plan administrator or training to be one, or even if you are a CFO or an executive on a company and you were addressed to be the one that takes care of the company's stock plan, well, you should start getting acquainted with these terms and regulations. Section 422 is the one that regulates incentive stock options. We have some others like Section 409, we have Section 16, and some other terms that will become important as you start administering your stock plan. Now, the eligibility, this is the first difference between NSOs and ISOs. NSOs, they are known to be more flexible, and ISOs, they have some requirements, and in exchange, they have a tax qualified treatment for the participants. ISOs are only available to employees of the company and must follow a certain set of guidelines and rules. Now, another thing is that ISOs are tax qualified, which is why they're called incentive stock options or tax qualified stock options or statutory stock options. These names are interchangeable, just as NSOs could be at NSOs for non-statutory stock options, could be NQs for non-qualified stock options. Compliance. ISOs have certain additional requirements, and that's what we were talking about. They are less flexible than NSOs, as they have some requirements to the stock plan, to the participants, and also to the way they can be exercised and disposed of. First of all, let's talk about the plan requirements. Now, written documents. ISOs can only be granted through a written grant agreement made under a written stock option plan. Now, if you are granting NSOs, you don't have to say much when you are talking about the stock options, the employee stock options. Well, they are in general NSOs. But if you want to grant ISOs or statutory stock options, you have to follow certain conditions. A few of those are that the grant agreement must be a written grant agreement. It can't be verbal. It can't be done in any other way other than a written grant agreement. And the stock option plan that this grant is coming from also must be a written stock option plan. This will have some other requirements as shareholder approval, board approval, and things as such. And another thing is that this plan must specifically mention that it allows for the issuance of Section 422 qualified options. If the plan does not say that it can issue these options, you will not be able to issue such options by simply putting on the grant agreement that they are ISOs. Now, the number of shares. When you are creating a plan, you have to define the size of the option pool, basically how many shares can be issued under that plan, pursuant to that plan. When you have ISOs, you have to say that, but you also have to say how many shares can be issued as ISOs under that plan. Now, this limit can be the same as the option pool, but it has to be separately determined. Time limitations. So, once again, NSOs are pretty flexible, but ISOs, they have certain limitations that NSOs do not have. First of all, ISOs must be granted within 10 years of the original date of plan adoption. We're going to talk about governing documents and the adoption of a stock option plan on another session, but just to define this here, we're not talking about the shareholder approval nor the board approval of the plan. We're talking about the date of adoption of that plan. And if it was January 1st of 2010, you cannot grant ISOs on January 2nd of 2020. Another thing is that issued grants must be exercised within 10 years of the grant date. Now, you could issue an NSO that expires in 12 years. You cannot do that for an NSO. If it has an expiration term bigger than 10 years, it is not an ISO and should not be considered as such. Employees only. So we talked briefly about this, but one important thing about the definition of employees only is that if the issuing company is a parent or a subsidiary, we're still counting as employee. So an employee of a company that is a subsidiary to the issuing company, they could still get ISOs. Tax implications. And now we're going to talk about the advantages of having an ISO, which is why we do have this balancing factor that are these limitations. So we're going to discuss mainly three important points in the life of a stock option. The grant date, which is when the company issues the option to a participant. The exercise date, which is when the participant decides to exercise their right to purchase the shares underlying the option. And the sale date, which is when the participant decides to sell the shares they purchased under that option. We also call this a disposition. Now, for options in general, there are no tax implications on the grant date, and that goes for ISOs and NSOs. However, on the exercise date, when you have an NSO, and we talked about this on the NSO session, the spread between the exercise price and the FMV on the grant date. So let's think about this way. The exercise price is how much you are paying for that asset. And it is defined by the FMV on the grant date, but let's forget that for a moment. We're talking about the price that you paid for the asset. And let's imagine that you are paying a $5 exercise price per share. And the FMV on the exercise date is how much that asset is valued on the date of exercise. So when you are exercising an option, would you agree with me that if you are paying $5 for something that is worth $10 on that date, you are receiving $5 for free? That spread between the exercise price and the actual value of that asset on the date of exercise will be measured as ordinary income. And ordinary income is generally like a salary. So we are measuring it as if it was a bonus that your company gave you, a bonus in the exact amount of the spread times the shares that you are exercising. Now, when you are selling these NSOs, you will have paid $5 for them, and you will have paid taxes regarding the $5 that you received from your company. So if you think of it this way, it's like your company paid the $5 for you, and you pay the taxes for the $5 that the company gave you. So you have no obligation over that spread. And that spread is the exercise price and the FMV on the date of exercise. Now, if you paid $5 and your company paid the other $5, and you pay the taxes for it, now you have what we call an adjusted cost basis. You don't have to become an expert on this right now, because we're going to have a session on tax implications. But this adjusted cost basis is basically what we're going to be considering as the initial price for you to calculate any other tax implications. So if you have a $10 stepped up or adjusted cost basis, and you sell you sell the shares for $20, now you are paying a capital gain over the $10. So you gained $10 in a capital operation, like an investment you are making in the stock market. What if you are selling these shares at $8 for an NSO, for instance? Well, you pay the taxes at the moment of the exercise, because the regular income is measured at the exercise and withheld by the company at the exercise. So now you are recognizing $2 of capital losses. For ISOs, this is a bit different, and we're going to talk only about qualifying dispositions right now. A qualifying disposition is when you sell your ISO, the shares you purchased under your ISO, in a manner that they keep their beneficial tax treatment. So at the moment of the exercise of your ISO, you pay no taxes. The company will not measure any ordinary income, and they will not withhold taxes either. So let's imagine the same scenario where you have a $5 exercise price, a $10 FMV on date of grant, and you are selling those shares 2 years later, 3 years later for $20. Now, you paid $5 for those shares, and your company is not recognizing those $5 spread from the exercise price to the FMV on grant date as compensation. So that $5 is kind of in a limbo. So we're going to have to account for that right now at the moment of the disposition. And in a qualified disposition, all that amount will be treated as capital gains. But you will pay taxes for the $5 spread too? Yes, you will. So what's the advantage in that? First of all, you are not withholding taxes at the moment of exercise. Now, there's a big difference on you having to pay for something and then having to pay taxes for something that you don't know you're gonna make a profit out of. And you pay for something and you only pay taxes according to whatever you gain from that transaction. So that's a very good benefit. Now, another thing is that capital gain taxes are usually less expensive than ordinary income. So you have yet another benefit on that. And as a matter of fact, as this is a tax benefit, when you exercise ISOs, you will have to talk to your accountant so they can calculate the alternative minimum tax. Now, the alternative minimum tax is an alternative tax calculation method that is done in parallel to your regular taxes. So, on the alternative minimum tax, some of the tax benefits that you received will be input in that calculation to make sure that you are not getting tax benefits in excess. Now, once again, we're going to talk more about taxes on another session, but I wanted you to have this overview because it's very important to understand what we're going to talk about right now. Now, what are the requirements for holders and the grants specifically? First of all, when we are granting, we have to check if that person is a 10% shareholder, the participant who will be granted the optionee. Because if that person owns more than 10% of the company, then the exercise price must be at least 110%, and the term of the option, or for how long it is exercisable, should be a maximum of 5 years. Now, remember that we talked that ISOs can't be exercised after 10 years from the original date of grant. For 10% shareholders, that limit is shortened to 5 years. And when we talked on our session about exercise price, how to determine exercise price for NSOs, it was 100% of the FMV on grant date. Well, for 10% shareholders, it is at least 110% of the FMV on grant date. ISOs can't be granted otherwise to these special shareholders. If you do not impose a at least 110% FMV for the exercise price, this is not an ISO. And that's something that's important for ISOs. If they do not obey the rules, they should be considered NSOs, which is kind of the standard. The 100K rule. Employees cannot have more than $100,000 worth of tax qualified stock becoming exercisable in any given year. And by becoming exercisable, I mean becoming exercisable. I can't stress that enough because it is different than vesting. If an option has an early exercising provision, for instance, that will allow you to exercise your options since the first day it has been granted, you will count the first date of grant and all options as becoming exercisable on that date. So if you have 100,000 shares being granted under an ISO, and each option has a $2 exercise price, or the FMV on the grant date, which is the most important thing here, is $2. That means that only 50,000 of these ISOs will be tax qualified. The other 50,000 will be treated as NSOs. Now, how do we calculate that? We calculate that by measuring the amount of options that become exercisable on any given year times the fair market value on the date of grant. Now, we do not use the fair market value on the exercise date or the date it becomes or the date of vest or anything of that. We will adopt the fair market value on the date of grant as the rule for our 100K rule calculation. So I just said that if more than $100,000 dollars worth of stock becomes exercisable in any given year or on an early exercisable option of 100,000 options, the excess would be treated, the 50,000 would be treated as NSOs. That will also be applied to subsequent grants. So if you have an option vesting over 4 years that is granted in 2022, and you have another option granted in 2021 that also vests over 4 years, you will have to calculate if that second option will exceed the 100K rule by counting the options becoming exercisable from that first grant as well. And let's say it does not reach that, and in 2022 you have yet another option being granted that vests over 4 years, and now in 2023 the 100K limit will be reached. Now, on that year, whatever excess to that amount will be treated as NSOs. Now, you will calculate then the limit for 2024, and we still have the 3 grants becoming exercisable in 2024. So, yet again, you will have part of that third grant becoming NSOs. Now, in 2025, you have only the second grant, the grant from 2021 and the grant from 2022 vesting. Now, at this point, it may be that you have you don't need to disqualify any of the options being granted, but just to give you an example of how this is calculated, we will go into this in a deeper way later. Now, the 3 months window, ISOs must be exercised within 3 months after an employee leaves their company. Even if the company gives you a 6-month post-termination exercise period, if you don't exercise ISOs within 3 months from leaving the company, whatever you exercise after that period will be treated as NSOs. They are still exercisable, but they are no longer tax qualified. Form 3921. When you exercise ISOs, the company will need to file and submit Form 3921 at the beginning of the following year. Form 3921 will have important information pertaining to your exercise and will also be essential for you to calculate your tax obligations in a disqualifying disposition, because you will need to measure income in that scenario. So you will need the information from your Form 3921 to go back in time and have that data available for you. Holding period. To maintain a tax qualified treatment, ISOs must be held for 2 years from the grant date and 1 year from the date of exercise. If you are granted an ISO in January 1st, 2020, you exercise this in August 1st, 2021, that portion that you exercised in August you can only sell this at a qualifying disposition or with a tax benefit after August 2022, because both periods must be met. 2 years from the grant date, 1 year from the date of exercise. If you sell the shares in a disqualifying disposition, or that means you have not followed one of these holding periods, then ordinary income will be recognized, and we'll look into that at another moment. Now, that's what we had for ISOs today. We're gonna meet each other on a next session. Hope you enjoyed this, and let me know in the comments if you have any questions or if this material has been useful to you. Thank you.